today we're going to talk about a few things. We're going to talk about why tax? Why are we even talking about tax? What are the common tax filing mistakes made by Canadian residents? We're also going to talk about how to proactively avoid tax filing mistakes. We're also going to look at how to actually file like a pro, and finally how to maximize every dollar. So you guys that said, oh, you want to save more money, you want to make sure that you understand what's going on with your taxes, you're in the right place. And if you stay till the end, you might just win a cash prize. So listen up, grab your notepad, and let's have some fun learning together. Okay. All right. So before we go ahead, meet me. I am Susie. You would know me as Wealth with Susie on all my different platforms. So I'm on Facebook, I'm on Instagram, I'm on TikTok, and I'm also on YouTube. So if you're not following me, make sure you're following me and make sure you're subscribing also to my YouTube channel. And I am a licensed professional here in Canada. And basically, my mission is very simple to make sure that you have more money in your pocket and to protect that income, because of course everything revolves around your income, to help you build a stable financial system such that your everything is working the way it should actually. And the focus is more towards using tax smart strategies. So we want to make sure that you're putting in a lot of money at the right place, not putting in money where your money will be leaking somewhere. Okay, and I just want to put out this disclaimer as well. I am not a CPA. I am not a tax accountant. This session is strictly for educational purposes. So if you're looking for specific tax filing, specific tax filing needs, like different things you really want that is very, very tied to your specific situation, please feel free to reach out to a tax professional, okay, or an accountant or anyone along those lines. Okay. All right. So now we're moving on. And this is the first part. This is where we talk about why tax. So you might be wondering, why am I even talking about taxes? So there are two key things that are kind of very close to my heart. The very first one is I've had a couple of my clients reach out to me asking me questions about taxes. And I just felt, you know what, instead of answering questions in different sites, it's just easy to have it like a one-stop shop where I'll just give everyone that information that is required. Okay. And then the second one is I actually had a personal experience. So 2 to 3 years, well, I think 3 years actually here in Canada, my tax got reassessed. And I don't know if any of us have had that scenario before. It happened to me. And the reason was I didn't know I was supposed to file investment income. So, you know, like when you have money in the bank, you have your mutual funds. I wasn't aware that, oh, the small change I made there, I was supposed to file. So I filed my taxes without it. And lo and behold, towards the end of the year, I got a reassessment notice and I was like, okay, what is this about? So again, lack of knowledge is not an excuse. And that's also part of why I am talking about this tax as well. But again, while I was just researching, like, why should I even talk about tax? I found this online and it will interest you to know that according to Fraser Institute, 42% of the average of a Canadian family are actually are actually paying this much. Like 42% are spending all their income on taxes. And you know, another thing that was really very close to my heart was I was like, okay, tax is not even like one of the basic needs. All of us learned in school, right? You have food, shelter, clothing. Those are the three main basic needs. I remember very well then. And then I looked at clothing. I said, okay, even if I add the cost of the percentage of clothing plus the percentage of food plus the percentage of housing or mortgage, everything is 35%. And that is still less than total taxes. So if you're a maths person or if you're very analytical, you start to wonder, like, why are people losing a lot of money to taxes? And that's part of why I felt, okay, you know what? this is something that we need to talk about to ensure that we have more money in our pockets as against dashing the government money that they literally didn't work for, right? Okay, so now let's talk about common tax filing mistakes. And the very first one we're going to talk about is missing tax deductions. And in very simple terms, these are deductions that basically reduce your net income, which is like the number that the government uses to determine your eligibility for any benefit. So it can be CCB, it can be GST, EST, all the other benefits. This is the number that the government uses to determine that. Okay. And the very first one is your RRSP contributions. Like RRSP, it lowers your tax bill. So this is usually for people that have high income, right? You have an RRSP. Any amount you pay into this, your RRSP, it actually reduces your net income. So this is something that you need to make sure that you get a document from the wherever your RRSP is domiciled. Get that there's a form, I think it's T5. They give you that form, you add it to your taxes. So you don't want to lose that out, or else you will get reassessed like me. Okay. Then the other one, FHSA. So this is for first-time home buyers. You also need to make sure that you include that when you're filing for taxes. Okay. But that's for people that recently purchased a home. Then childcare expenses, moving expenses. As long as you move more than 40 kilometers, you need to also include that because that will help reduce your income. Initially when I moved, one of my very first moves, I didn't reduce anything because I didn't know. So you don't know you're leaving money on the table. So trust me, you want to make sure that you get all of those receipts together. Then if you're part of any union or professional dues, you want to make sure you're adding that as well. Then for those of us that work from home, your employer gives you this T2200, and this basically shows them how much you're working for, the amount that you're entitled to. So in terms of like your utilities, your rent, those kind of deductions can be made because you're working from home. So make sure that you are doing that. You are filing that as well. Okay. And then of course, any business expenses that you have. Okay. So the second mistake now is missing tax credits. And this one is slightly different from the other one because the other one is applied directly to your income, while this one is applied after your tax is calculated. After your tax is calculated. So you're talking about charitable donations. Those of us that make donations in church, you make donations for all these other institutions that take donations, right? You want to make sure you're getting all those receipts together. Or you have medical expenses. Medical expenses are also key. It could be prescription, like things that fall under that bucket. You want to make sure that you're using this as well. And then tuition, if you're in any school or you have exam fees, you need to also include that as well. And then interest on student loans, training credits. If you're carrying out any training, it could be school training, whatever training you're going through, as long as it does qualify for continuing education and you're over the age of 26, then you should actually do that. And there's a way you can actually find out if you qualify or how much you qualify for. This information is usually in your notice of assessment. So you might want to check that and make sure that you're maximizing that if you're doing any form of training. And then digital news credits. So these are for people that subscribe to all these big newspapers like Globe, More. There are all sorts of newspapers or digital news. So if you do subscribe, you do have a chance to actually get this to be applied after your taxes. And that way you're reducing how much you pay on taxes. Okay. The next one is where you're kind of matching the wrong accounts to your tax brackets. And this is a mistake I see every time. A lot of people, number one, do not have a tax-free savings accounts. Like you want to save on taxes, you want to have more money in your pocket. So why don't you have a tax-free savings account? And it's free, like the government doesn't charge you anything. They don't charge you for putting money. They don't charge you for any growth on that money. They don't charge you when you withdraw the money. So why don't you have one? So this is for everybody. Low income, if you have low income, yes, you can do that as well. And if you do have high income, and high income is relative, right? It all depends on, usually I would say 80%, 80,000 and above, or sometimes 90,000, it all depends. But if you find that you're paying a lot of taxes, by the time you check your paycheck, you would know. If you're paying a lot on taxes, you might want to use another strategy and pay pay in money into this RRSP account. And the reason is simple. When you pay the money you pay into your RRSP, it reduces your taxes for today, right? In the future, you will pay those taxes, but for today, it reduces your taxes. So, for example, if you're in a low income, if you're in a high income, and you feel like maybe next year I may not have this job, or I may have like way lower income, then it's good to maximize it this year so that the following year you can now pay it off. Or if you're thinking, oh, in retirement, I probably will not have as much money as I have now, then you want to make sure that you're putting it in your RRSP so that at retirement, you will be on a lower tax bracket. And because you're on a lower tax bracket at that time, you will be charged lower tax. Okay, so it's very important that you match the right account to your tax brackets so that you don't have to pay more when you can actually pay less. Okay. The next thing is the refund trap, and this is one that this is one that actually used to happen to me then when I came initially. You get a refund, you're all excited. Oh, I have a refund from the government, it's extra money. I can use this money to do this and that. But the truth is, it is not a gift. It's your own money returned to you late. So it's not free money. So it can happen two ways. It can be that you either overpaid CRA, and basically the government just decided to use this money to fund their project. So instead of you having more liquidity, instead of you having more cash in your pockets, this money, the government is using your money. And then at the end of the following year, they then pay it back to you. So you're literally giving them a loan to do their own transactions. While you probably would have used that money to, let's say, pay down on a high interest loan, like maybe your credit card, or even invest it. So the truth is, it's not free money. It's not free money. So, but how can you actually use this money to, how can you use this money in a way that you're maximizing it even when you get, because the truth is sometimes you really don't have control over overpaying the CRA. And I say that because because especially for those that are employees, right? Your tax gets deducted from source. So if a mistake is made from your employer, then there's really nothing you can do to correct that. So when this money comes to you, what do you do with that money? So there are a few things you can do with this money. You can automate your payments to your RRSP TFSA. So you want to make sure that when you have this TFSA RRSP, you're not paying lump sum. And it's not that it's not good to pay lump sum, but there is value in compounding interest, right? So you want to make sure, and what is compounding interest? Compounding interest just means that the value of you putting in $500 as a lump sum today is different from the value of you putting in, let's say, like a 200 every month. And the goal is, yes, it's the same, but you see that 200, as you're putting in the 200, it means that, let's say you're purchasing, your funds are invested, maybe mutual funds or any funds, right? At that time when you're purchasing it, let's say the first month of the year, you put in your 200. The cost of that fund may be higher or lower. The very next month, when the next 200 comes in, the cost may be lower or higher. So at one point or the other, it may benefit you more than if you paid in, like, okay, let's say I paid in 10,000 at once. And that 10,000, maybe at that time, the cost of the investment is way lower. So you'll be making a huge loss. So for people that actually, uh, and just so you don't misunderstand me, it's not good to pay in lump sum, but there is value in spreading it out. So you can maximize how much investment you're making and maximize the different interest, the different rates in return at the market, right? You want to make sure that sometimes when it favors you, you're also buying. And even when it doesn't favor you, you're buying. That way you're paying, you're getting more on the days that the rate is higher. You're getting less on the days that it's higher, and then you're getting more on the days that the rate is lower. So that way you're kind of there's a balance. Okay. And then if you have any debts, high interest debt, especially like high interest, usually these will fall under your credit cards or personal loans, depending on what you have. Please, if you do have these refunds, those should be the first places you should go to deposit that funds, because you want to bring down the interest that you're paying. And then your legacy plan, right? For people that have maximized everything, you've maximized your contributions, TFSA, RRSP, the permanent life insurance is a very good place to also grow your money tax-free. So that might be something that you could also leverage as well. Okay. So the last mistake, it has to do with leaving your children a tax bill instead of a legacy. And this one is very interesting, because this actually happened here in Canada. A couple of us would have seen there was a video and there was a story along those lines, and basically it was the parents died, and then the lady or the family had to, or the children actually, they had to cough out 660K. So you want to make sure that you're maximizing your tax bill. You're using the right strategies. And I gave a quick example here. Like, a lot of us don't really think about what happens when we're not here, right? But God forbid this happens. You have a home, you've stayed in the home for 20 years, your home has grown, your home has appreciated, and then God forbid something happens, the person dies. When there's a death, the CRA, it treats it like the house was sold the day before. Okay. So if the house is sold the day before, then TRA is like, okay, is there a gain or a loss? If there is a gain, you need to also include that, right, in your in the tax filing. And basically, so for example, for a home that costs, let's say your home, you at the time when you purchased the home, it was 500,000. And at the time of sale, which is at this person's death, right? At the time of sale, the amount has increased to like 600. So you've made like a capital gain of 100,000. So from that 100,000, that amount is supposed to be added to your taxable income. And you're supposed to pay the government 50% on that. So 50% on 50,000 in this scenario, 50% on 50,000 times your marginal tax rate. And your marginal tax rate is basically that rate that you pay, the amount the rate you pay depending on how much your income is, right? So that is what the government takes. So imagine this family now had no plan. It will fall to the kids, right? Because they would have to sell the house or sell whatever they have to get this money. But if they did have a plan, which I hope all of us here have, or at least are planning to have, they probably had like a life insurance where the coverage would actually cover the cost of that home. All the kids need to do is to still keep everything and use the life insurance, pay for the home, and everybody continues life as it's were. Nobody's going to, well, they will of course miss their parents, but trust me, having to deal with financial issues when you've lost a loved one, no one wants to actually be in that situation. So you want to make sure that you're thinking about, oh, what happens if I'm not here? Am I leaving my kids, mogbese, as we will say in Nigeria? Or am I actually giving them that legacy such that they will always remember me and always remember that I did the right thing for them while I was still living? Okay. So we were done with the mistakes. Those are the mistakes. So now we want to talk about how do we then avoid this tax filing mistakes? Because yes, we are hearing all of this for the, well, some of this will be new to us. Some of this we will be hearing for the first time, but how can we actually avoid this happening? And like I said here, pre-filing audits, like you want to make sure you are checking through everything. Don't leave it to chance. Any money you don't claim or you don't include, the government takes that money and your money is gone. So the first thing you want to do is you want to check your CRA accounts. A lot of people don't really check these accounts to say, oh, let me even see what's my contribution limit, what's my RRSP contribution room, what's my TFSA contribution room, because of course, if you exceed any of these rooms, you will be charged, right? There's a penalty. So go in there, log in, you will see your details there. Check all of these and make sure that everything that you have there, like all your different accounts, are aligned with what you should actually have. You shouldn't have more when you shouldn't pay more when you should be paying less, right? If you have any of your accounts, because again, you're paying these accounts into your bank. Your bank is not helping you check whether your limit is okay. Your bank will just take the money and use it for whatever they want. It's on you. So you want to make sure you're checking that and deciding on, okay, this is how much I want to contribute. This is even how much training credit I have. Some of us, we don't even know that for training, there is a credit. And I believe the maximum for a lifetime is 5,000, right? But you don't know, you will not know, and you will never know, right? So unless, of course, we have all these kind of sessions or you find out somehow, or you even have someone who's helping you file taxes. So do your own due diligence, check your CRA My Account, and make sure that your details are correct. The other thing again that you should take key note about is receipts. Like a lot of us are bad with receipts, I included, right? Because again, how many bills do we pay in Canada? Loads, right? So, but you want to go through each account. Some of us have 3, 4 accounts, 5 accounts. Go through each account, look for keywords, especially if it's the online, if you're logging in online on a desktop, because I think it will be a bit tricky on the phone. On a desktop, you want to check, okay, clinic, pharmacy, tuition, moving, like so many things happen during the year. Of course, it's the previous year you're checking for, but so many things happen. And if care is not taken, you will forget. I have forgotten removing receipts, for example. I have forgotten investment income. And of course, those for investment income, they will reassess your tax. Moving receipts is your loss, right? So nobody's going to ask you that one. So, but you want to make sure that everything claimable, you are claiming. Any opportunity to reduce your taxes, you are reducing that. Because again, we're working hard. You can't just be letting your money go down the drain. So checking this is very vital. Another thing you can actually do is to if there's been a change in your circumstance, so maybe you got married, you guys had a child, you were separated, whatever it is, make sure you do those updates before you file for taxes. And the reason is simple. It's for example, like if you have where if maybe you just got married or you had a child, there are benefits that accompany that. So you want to make sure you're taking everything possible. So make those updates before you file those taxes. Okay, and then your income, you want to make sure everything regarding your income ecosystem, like I called it here, right? Your T4 or T4s, for those of us that have 2 or more jobs, your side hustle, all them, you Uber, all them, skip the dishes, you are including everything possible. Rental income, those of us that have properties here and there, include all of that. Investment income, all of you that do ETFs, Wealthsimple, well, ETFs in Wealthsimple, right? Or anywhere else, stocks, all those things, you need to file them. Usually they have the companies will give you a T5, right? You need to include that in your taxes. Okay. And then, of course, you also plan for the next year. So planning for the next year is, if it's possible, and this is something I try to do, if it's possible, have a file. Anything you're spending, business income, for those of us that have a side business, anything you're spending that these are the likely things you will forget, put them in that file. You can put them in a digital file. It doesn't have to be like a physical file. Keep them there, name them maybe tax filing 2020, whatever, right? And let them be there as those costs accumulate, put them there so that when it's tax filing time, you don't start scampering around to say, oh, what am I supposed to do? Am I supposed to include this or that? So it's important that your planning for next year starts now. You don't leave that to chance. Okay? So that's about the tax filing audit. So how to file like a pro. So this one is very important because again, you want to make sure that every opportunity you have, you are double checking, especially for those filing by themselves. And usually, I would not recommend filing by yourself if your income is complex. But for people that have just one T4, don't really have much, you can actually do it yourself. There are a lot of tax filing softwares you can use. So double check, make sure that your T4, when your company issues it, you're not going to quickly file the next day. This one has happened to me. One of the jobs I worked in, my company actually amended my T4, and it was like a week after, not even 48 days, and not even 48 hours. So 48 hours is like the conservative amount, but of course, you're not going to wait till when it's April 28th before you file, right? You want to make sure you give enough room. So any changes that are made in that T4, you're able to adjust it before you file because anything after that would need a reassessment and you don't want to have that, trust me. Okay, and then for people that are filing themselves, you run those scenarios with the software. So whatever software you're using, whether it's TurboTax, whether it's Wealth Simple, test it, check out, okay, if I increase my RRSP contribution, let's say I increase it to 5,000 this year, what is the effect on my income? Many times, these filing softwares, they will show you, you would see, oh, this is how much tax refund you will get. This is how much tax refund you will get if it increases or reduces. That way you can also plan and say, okay, so this is actually what's happening next year. I'll make sure that I do the opposite. So you can leverage that as well. And then make sure you verify. So these softwares, they connect directly to CRA. And that is why they are able to many times pull out your T4, T5s and all. But it's important that you check, always check, always check. Do not rely on them because the truth is, even CRA makes mistakes. So, and one mistake actually happened to me. So part of when I came around the time where I got that reassessment, part of what they flagged for me was that, oh, I think I claimed training because I actually went to school then. I claimed training and they were like, oh, it doesn't qualify. So they in my reassessment, they said I was owing them $1,000 and they even added interest on that 1,000. So, but when I called them, I told them, see, I actually worked, I actually was schooling at that time, and I explained the scenario to them. And the person actually said, you know what, that's a mistake from our end. So, if you don't verify what is there, you will lose money and nobody will ask you anything. The government will chop your money. And so you just want to make sure that you are doing your own verification as well, checking to make sure, okay, does this really align? Is this really correct? And when you have questions, always ask. Okay. And then the last one is some complex income sources. So this is for people that have a lot. You have your personal, you have your T4 from your regular employer. You also have maybe 2 or 3 side businesses, or maybe it's 2 T4s. Once you have like a business and because of course for a business you have the ability to write off different things. You have the ability to write off a host of things, right? You want to work with a tax consultant. You don't want to leave because the truth is there are many things that the tax consultant would remind you of that you probably may not know. And sometimes they even help you get more money. So you want to make sure you're working with a tax consultant that would help you and make sure that you claim everything you're supposed to claim. Okay. So now talking about how to maximize every dollar. So this one is very key, and okay, I'll start with the spousal RRSP, and this one is many times you have husband, wife in two different tax brackets, right? One is earning way higher than the other, and let's say that person has maximized every avenue for reducing their taxes, right? After you've maximized, you're still having a very high tax bracket. You want to also try and say, okay, what if I contribute to my spouse's RRSP? And the reason is simple, it will bring down your own taxes. Okay. And then it will, and then eventually your spouse, it will be when your spouse is withdrawing, it will be at her own tax bracket. So that is something you could leverage if you have that kind of scenario. Okay. Then a lot of us use GICs, high interest savings, ETFs. It will interest you to know that you are taxed at 100% for these guys. So make sure you have used your TFSA, you have used your RRSP, you have used every other avenue for maximizing your taxes. The 100% means that whatever you're getting there, the government taxes you that 100% on your tax rates, your marginal tax rates. And your marginal tax rate is simple. That is your tax rate. That is how much tax you are being charged depending on your tax bracket. So this is fully taxable. There is no, this for me, recommendation, this would be like when you have fully maximized every other avenue, then you can use these guys. Okay. Then for your Canadian dividends, for those of us that have stocks that pay dividends, these ones are taxed at 50%, 50%, but depending on whether it's eligible or non-eligible, and this is usually for very large corporations, the larger corporations, they pay you a bit more tax credit. So what this tax credit does is it helps you reduce your taxes. So I will do this before I do that. Okay. And you also have capital gains. Capital gains is for those of us that have real estate, stocks, things like that. And this is also at 50%. For real estate, it's important to point out that real estate, if it's your primary residence, you do not pay tax, but you need to let the government know that you bought a house. There is some documentation that goes in. But of course, as long as you specify that it's your primary residence, you pay no tax. But where it's a rental income or it's a rental property, there is tax to be paid. And 50% on that will be paid, of course, based on your marginal tax rate, which is the tax rate for your income level. Okay. So this guy would be the lowest for me. Then these other guys would, as in this one would be the GICs, ETFs. These will be after you've maximized every other avenue. I wouldn't go here first, just to point that out. Okay. Okay, we're almost done with. Okay, so now conclusion. So it's very important we reconcile all our 2025 slips and run those scenarios so that you can find anything that you really haven't included and include it before then. And try to do these things before April 30th, right? You don't want to wait till the last minute where you're trying to put things together when it's very close to the date. Get everything ready before then, if possible, and identify the ones you don't have. Don't always wait for, let's say you have an account in TD, you have in Scotia. Don't wait for them to send you those RRSPs, RRSP contributions or investment contributions. I've had instances where I had to personally go to the bank and ask them. So don't wait to be asked. Find out, check your accounts, any interest at all. You should have a T5. If you're not giving, go to the bank and complain, or give them a call. Let them send it to you. Because even if they don't send it to you, they will definitely send it to CRA. So CRA gets it and you don't file it, it flags something, and then they have to do a reassessment. So you want to make sure that you check everything, okay? And then you maximize your deductions, claim any dues to lower your taxable income. Of course, you don't want to be paying more when you should pay less, right? Claim any credits. Don't leave money on the table. Donations, all those things. Make sure that you claim all of those. And then if you have a business, please, it's DIY. is good for many things in Canada. But trust me, for business owners and for people that have a lot, like a lot of T4, T5s, and a lot of investments, a lot of income, you want to talk with someone who is licensed. You want to talk with someone who would guide you through and someone who will be able to identify those flags before CRA flags them for you. Okay? So it's very important to note that you see this tax season, it's not really an administrative burden. We should see it as a wealth strategy. And that's why, yes, I may not be a tax consultant, but I feel it's very important to talk about it because imagine you're saving so much money and then the money you're saving, you're literally saving it in the wrong places. And because you're saving it in the wrong places, you end up paying more taxes. You end up having less money in your pocket than you should have. It's not a very good strategy. So you want to make sure that you're maximizing everything and you're not leaving any money on the table. So I'd like to invite you to join my WhatsApp community. It's just a safe space where you can ask questions, anything financial, if you're looking to leverage your tax smart strategies, if you're looking to just have that chat and talk about anything regarding finances, please feel free to join that community as well. And then you can also subscribe to my YouTube on WhatsApp. You can also chat me up. My number is on the screen. And please feel free to follow me on Instagram, Facebook, TikTok, and subscribe to my YouTube channel. Thank you, everyone. Take care and have an awesome rest of your day.